Hello, Anna. Welcome to another session. All the Linwood Bridge franchise clients, as you've heard in the newsletter, we are going to make a few changes when it comes to our discretionary investments, our living annuities, and our endowments. And I thought it would be great to actually include Lafras Moolman in today's session and tell us a little bit more about who is Peregrine Capital, first of all, and then how does hedge funds work? Because that is the main change that we're going to make. We're going to include some hedge funds, and the best way to describe that for us is Lafras Moolman. So I'm going to add him, and just to quickly give you a little bit of a background on Lafras, he studied his LLB. He also has his MBA, his master's in business, and then he was an investment specialist for 13 years at Old Mutual, and now currently at Peregrine Capital. So he is a well-informed, well-educated individual who loves investments. And from my side, Lafras, thank you very much, first of all, for joining us and giving us your time to come and explain to all my clients who Peregrine Capital is and what you guys are about. So welcome.
Thanks so much. Thanks for the opportunity to obviously have a chat with your clients and explain who we are and what we do, and obviously to show the benefit that what we do can bring to the portfolios going forward.
Lafras, so before I throw your presentation on the slideshow, can you maybe just give us a quick, in layman's terms, who is Peregrine Capital and why should one include hedge funds, or is that all part of your presentation?
Well, we'll jump into those in the presentation. So I think it would be good if we can jump into that thing.
All right, perfect. There we go. The floor is yours.
All right, thanks so much. I think before we just start on who we are as a business, maybe we just need to understand the regulatory environment of hedge funds. Prior to 2015, hedge funds were not regulated in South Africa. I think that might be one of the reasons why most clients would have had not seen the name Peregrine Capital before in the market. And then secondly, before it was regulated, you as a financial planner could not give advice on hedge funds. So fortunately, 2015 came, the Reserve Bank and the FSCA included hedge funds under the Collective Investment Schemes Act, and we are currently regulated with the same regulations as the normal unit trust funds that your clients are already used to and are already using. The benefit is that after 2015, we as hedge fund managers could actually for the first time set up funds that looks and smells like a normal unit trust funds in terms of how they function. When I say function, I mean the fact that we could put them on the investment platforms, for instance, Momentum Wealth or Signia or all the investment platforms that you've got access to. And these funds do price daily, so they're daily priced. Clients can actually now get into the funds on a daily basis and also get out of the funds when they would like to. So you can draw income from the fund, and the accessibility of our funds is just so much wider now than it's been previously. All right. Another thing to mention is you as a Momentum Consult advisor are one of the very few in South Africa that actually can give advice on hedge funds. There's only a selective few that does have the license in South Africa currently. So, you are in a fortunate position to actually widen your value proposition to your clients where other financial planners without the license cannot utilize our funds. All right. So just from a background point of view, Peregrine Capital is the longest running hedge fund asset manager in South Africa. We've been around for the last 25 years. Our oldest fund has also been running for 25 years. 25 years back, our minimums were R1 million. So we actually only catered for very, very high net worth clients and institutional clients at that stage. When regulation changed, it opened up the door for us to decrease those minimums to make it accessible to the normal guy on the street and actually create exceptional wealth for the normal guy on the street, not just the ultra rich or the wealthy clients in the country. So we've been around the block. We're not a fly-by-night asset manager with a 5-year track record. We've got a 25-year track record, And currently we're managing around 15 billion rands worth of client money. Now, in the bigger scheme of things, that's not a lot, but we see ourselves as that speedboat that can go around the big oil tankers, move quickly in the market, in and out of shares, and create opportunity to create wealth for our clients. We've been using the same investment process for the last 25 years. It's a written down, bottom up approach. We've got about 6, 7 analysts in the team and 4 portfolio managers that looks after the funds collectively. A very well established team, and Dave, our founder, is still one of the portfolio managers there for the last 25 years as well. So we've got a leading alignment with our clients. All our liquid wealth is also invested in our funds. So we actually manage the money. The money in the funds aren't just the client's money. We're not just taking chances with clients' money. It's actually a big portion of everybody's liquid wealth is invested in the funds. We're one of the biggest investors in our own funds. So we go to work with the idea that we don't want to lose our own money. It's not just the client's money we don't want to lose. We also don't want to lose our own money, and I think that's a very good alignment to have with your clients. And we've won numerous awards over the years, which relates to the hedge fund industry. All right. So just to touch on the 2 funds that we'll be including into the portfolios, you can see it on the right top hand corner. Our high growth fund is the first fund in South Africa to actually deliver 100 times client money. If you invested R1 million in that fund 22 years ago, it would have been 134 million rand today. There is no other fund in South Africa that could achieve that. So very, very nice fund to include for especially that growth portion of your portfolio. And then the pure hedge fund, our low risk solution, has never had a negative calendar year in the last 25 years since inception. All right. So
that's brilliant.
Just to show where the funds fit in, this is over the last 15 years. You can see on the left-hand side, the bottom left, and the top left, our pure hedge fund compares to a typical stable fund. A cautious fund, a low equity fund, that's where our pure hedge fund fits in terms of risk return. And as you guys can see, average stable fund over the last 15 years delivered 8%, almost 8% net return after fees, where the pure hedge fund almost delivered 12% net after fees. Then if we move to the second fund here in the middle, this just illustrates that our high growth fund does compare with a typical balance fund that your clients are used to in the unit trust industry. They've been using them in their retirement annuities, preservation, providence funds for since they started working. So they're used to those type of funds. The high growth fund is similar in terms of risk return and asset allocation. And as you can see, the high growth fund has delivered 15.7% net over that 15-year period, annualized year on year.
I think the one thing there, and you're probably going to touch on that later, but the sessions myself and Lafras had is the reason why we are adding Peregrine Capital is when he explains now exactly how a hedge fund works, where you can basically win on the up and the downside of the market. But the good thing that I picked up and why I've decided to include it is that the growth is more, and even though we don't sell or give advice on growth, but I'm reducing your risk. So it's a win-win for all of your for all of my clients' portfolios and all of you watching, that we can get better returns for a lower risk, where normally we actually have to go higher risk to try and get a higher return, where now we can get a higher return with a lower risk. So I just wanted to add
that's perfectly explained. Yeah. So traditionally we've been taught if you want higher return, you need to have more equity exposure within your portfolio, and then you'll move more right in terms of risk and hopefully higher in return. The benefit of hedge funds is actually the other way around, as you mentioned. Now we can, with less risk, actually with reduced risk, give you this very, very good high double-digit return figures. All right. So if we just touch on the differences between us and unit trust funds. So if you look to your right, you'll see under unit trust fund, their strategy is limited to a buy and hold strategy. There's nothing wrong with that strategy. We make most of our money by buying shares and holding those shares for a duration, but that is their only strategy. So what that means is they are dependent on the market that has to rise, or the share price that has to go up, in order for the unit trust funds to actually accumulate returns. So if you move now to the left-hand side, we also include a buy and hold strategy. As I mentioned, it is one of our main strategies within our solutions. But the difference is, we feel managing a unit trust fund is like managing money with one hand tied behind your back, where a hedge fund can actually manage money with two hands. So why we say that is, our strategy is more flexible. We've got more tools that we can utilize within our tool set than what the unit trust funds have. All right. So buy and hold, buy shares and hold them for a duration is absolutely one of our strategies. But the difference is we can utilize short selling. And in layman terms, it just basically means we can take a position against a share that we think is going to reduce in value, its share price in value. So meaning that, we think a share's price is going to fall in value, we can actually take a position against that company and make money while that share drops in value. And just to mention, I mean, Wilco, we can, if there are clients that wants to do individual sessions or group sessions to learn more in terms of what we do, we can obviously set that up and run those clients through the more nitty gritty of how it works, how we utilize the short selling. Then, we utilize special situations. Just in short, that just means, very, very complex situations in the market. We are very good at analyzing those, and we are very good at extracting value from situations that the typical unit trust manager is too big to participate in, or secondly, just the complexity of the situation is so immense that they usually don't spend time on that. And we've made a lot of money for our clients by utilizing these special situations, looking at small cap shares and mid cap shares, and we can literally invest across the whole spectrum. Then we also utilize pair trades. That's another one of our main strategies. And again, just in short, what we do there is we have the ability to play off a good share against a bad share. Bad share meaning that share is the worst according to our predictions or our calculations within a certain sector, for instance. We don't think it's going to go to zero, but we just think that share is not going to grow. Then what we do is we play off the shares against each other, and that enables us to take out the market risk, because you're actually playing off two shares against each other instead of just buying and holding one of them. Then you are fully exposed to the market. If the market falls, that share will also fall. But when we utilize pair trades, your position basically stays parallel with each other and just falls together when there's a COVID or a Ukrainian war. All right. So through all these different mechanisms that we've got, it enables us to basically reduce the risk within the portfolio. Another mechanism we have is we can buy insurance on our funds at any size and scale on any instrument, which means it's like a life policy that we can buy on the market. We pay a premium for it. If the market dies, the policy pays out. And we utilize that throughout, different market cycles, and where we see headwind. We currently do have a very large position in insurance, currently on the S&P index as well, just to bring in that additional support or additional protection for clients that's invested in our funds. And that will obviously relate back to your clients as well. They'll also share in that additional protection that they might not have in the unit trust space. All right. Just lastly, to touch on, so we don't have a benchmark that we try and outperform. We feel the client should be the benchmark. We want to deliver the best possible returns we can for our clients, and we have the client as at the center and not just trying to outperform a benchmark at the end of the day. Okay.
Sounds good.
So maybe just in conclusion, and I mean, you will discuss the allocations in more details with the clients, but what we've done here is, this is just, again, that typical risk reward table, where the more to the right at the bottom you are in terms of percentage, the more risk you took, and on the left-hand side, it reflects the returns of that portfolio. This is since 2014 to end of February this year. And what it shows is the normal growth portfolio sat around 12% in terms of risk, and it delivered just under 12%. By including our funds, it basically moved the portfolio more to the left, and that's exactly what you want. It's sitting around 10% volatility, and it increased the return to over 12%. And that's what we try and achieve by adding the hedge funds. It should, as you mentioned, reduce the risk in the portfolio, move it more to the left, but also increase the return at the end of the day. And I think that's the benefit, the ultimate benefit that our funds bring to the portfolio. You know, when the market is down -15, your portfolio might only be down -3 or -5. You know, it's much quicker for that portfolio to get back to zero and start going into positive territory again, where someone that's down -15, if they do +15, they're not level yet or at zero. They have to do around 17, 18% to get to a positive territory. And that's the benefit that the funds would bring to the portfolios. But as I mentioned, any other questions from clients, you know, more than welcome to reach out. We can set up individual sessions with them.
Yeah, I think one of the things also, and it's important for everyone to see there, that Lafras actually included the Linwood Bridge growth model that we're currently structuring. One of the questions that comes up, Lafras, and that we might get, and you can maybe elaborate on that, and I think we've had the discussion, is that a pure hedge fund like yours, is it an all or nothing? And maybe just include, why did we decide to I think we're adding about 28% of your fund into the model. So the clients might ask, but hey, if it's good for me to rather reduce the risk and have higher returns, why don't I go all 100% into the Peregrine hedge funds? So what is your view on that?
That's a very good question. So to summarize that, I mean, at the end of the day, it all comes down to diversification. So I think we've included 25% of the high growth fund in the growth model. So we don't move exactly like the market moves. And where there are very strong bull markets, our funds won't necessarily generate the types of returns that a normal unit trust fund would, because we always have that middle point of we always should be hedged within our portfolio. If you are too hard hedged in a bull market, you're going to give up on the performance. But again, on the other side, if you are too softly hedged and the market falls with a Ukrainian war or interest rate hikes or COVID, you're going to take that downside risk again. So we need to find a sweet spot somewhere in the middle to always set a hedge within the portfolios to protect. And that's why you want to blend it with other funds that move differently. And that's where your correlation or your diversification comes in. If you are only in one roller coaster, you're only going to experience one way of movement. As soon as you start putting stuff together that do not move like each other, you're getting a much smoother ride to the upside at the end of the day, and you delivering a better experience for the client while they are invested. Yes, they might be down -5, but everybody else is down -10. They get to a zero in a month's time, where everybody else gets to a zero only in 4, 5, 6 months' time, when your clients are already in a positive territory. So it is not just an all or nothing. You know, we don't want to replace what you are already using. We rather want to be an add-on to add to the overall portfolio and to benefit the overall portfolio, because there are brilliant other unit trust funds out there as well, and they will function in different cycles differently to us, and that's why, you know, you won't go 100% into our funds.
All right, perfect stuff. I'm assuming that's the end of our presentation. Am I right?
That is, yes.
Okay, brilliant stuff. Okay, so Lafras, from my side, I really want to thank you for your time this morning. You explained it in the simplest way. I know you guys can go in deep And that's why you mentioned also, if there are some of the clients out there who wants to have a one-on-one session, let's set it up. Get involved, because at the end of the day, it's your plan. But Lafras, thank you for your time. I really appreciate it. And
It's a
you
pleasure.
must have a
Thanks for the
good day.
opportunity. Thanks.
Alrighty, okay, so you guys saw why we are changing, why we are adding Peregrine hedge funds into our model portfolios. Thanks for watching this video, and please reach out if you want to have a session and know more about Peregrine Capital first of all, and more about how a hedge fund works. You've got my details. Get in touch. Have a great day further. Cheers. Bye-bye.